Hey everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague Ted Wayman. We're going to jump straight in. Today we're looking at Abbott Laboratories, which is a giant in the medical devices industry. Now they're a US-based company, but have centers all around the world, and they have essentially four main pillars in terms of products. So you've got pharmaceutical, you have diagnostic, you've got nutritional products, and you have vascular products. Now, this is going to be an interesting company to look at, as you'll see later on. They're a dividend stock, so they have been giving out dividends for 49 consecutive years. So it'll be interesting to see how much that continues. And as you'll see when we look at the share price, you'll see that if you're a value investor, for sure, you're going to be sitting on quite a big profit. So before we go into the finances, again, don't forget to like, share, subscribe. You'll get notification when you make a request of any businesses you want us to analyze for you. So Ted, let's jump straight to it. What have we found out about this company in terms of its finances, and what can we share with our viewers?
Well, thank you very much. Good to see you, Moeed, and good to see all our viewers. Don't forget to like, share, and subscribe. And if you subscribe, obviously you get notification of videos such as this one. So we are going to look at the financial statements, as you said, Moeed, and here we have the 2020 annual report and accounts. This is available on their website. This is the backward-looking presentation. We're going to tell you what's been going on in the past. We're not going to be telling you what's going on in the future. So if you are using this as part of your research as to should I be investing in this company, you also need to think about the market, the growth potential, and where the business is going, as well as where it has been. Past performance is no guarantee of future performance. So, however, this annual report does have a lot of information in it. It is a marketing document, so you need to kind of take it with a pinch of salt. Best foot forward and all that. Lots of pretty pictures as well. And we are really interested in the financials, and that's what we're going to be analyzing. So here we see the financials and top line. So we're dealing in millions of dollars. So 2020, the top line sales, $34.6 billion. And that's an increase of 8% on the previous year, which is an increase of 4% on the previous year. So this is a company which is continuing to grow. It's not massive, stellar, doubling every year, but good, solid 4 to 8% growth year on year. The next line down shows the cost of sales. Now, they don't actually give you the gross profit, but I've worked it out, and I can tell you that they're operating on a gross margin of about 57, 58, 59%, which looks pretty reasonable to me. So it's it is a kind of a high margin game once you get the right products, and it's basically saying that for every dollar that they sell, it costs them about just over 40 cents to make that product, and they get to keep the other 57 cents. They then got the costs of running the business down here, and you can see that there's some amortization. So the amortization, this is merely depreciation by another word. We depreciate tangible assets. We amortize intangible, or things we can't touch, like patents and licenses, for example. So this will be things like licenses that they bought to distribute certain products, and they are amortizing those. R&D, this is for the future, so they're investing in the future and kind of the pipeline of drugs that are going to come in. And then we've got the SG&A, sales, general and administrative charges, that you find in any company: selling, marketing, HR, finance, facilities and training, and all that kind of the other stuff, and rent and rates and travel. So really good, strong profit margin, about 15, rising from 12% operating profit margin in 2018, rising up to 15% in 2020, suggesting that they're keeping a control on their costs. So while the top line is growing, the fixed costs, that's these ones here, are also growing, but they're not growing as rapidly. Good cost control. What else do we see? There's a couple of other bits and pieces going on. So first of all, we could see that there is some interest expense. That's this line here. So this is telling me that they have some debt, but you'll notice that this has been coming down, so that not only do they have debt, but their debt has been reducing. They've been paying down that debt. And you'll see in the previous years, actually, they did some significant payments of debt, and that cost them some money, like a kind of early redemption fee, so to speak, but not this year. So all in all, the bottom line, let's just scroll down so we see the actual full bottom line. The bottom line is a really healthy increase in net earnings from 2.4 billion up to 3.6, 3.7 billion, and now at 4.5 billion. And what's quite interesting is to look at this earnings per share, which is pretty important, because quite often companies can disguise this kind of net earnings by kind of issuing shares, for example. And what we're really interested in is the growth in the earnings per share. And that growth in the earnings per share is really, really healthy. That's about a 20% growth. So looking very comfortable, very healthy, very strong profit and loss account. If we go and look at the balance sheet, if I can just find the balance sheet, here it is. So in terms of the balance sheet, here are the assets. I'll just scroll down so we can see that. So we can see in terms of the assets, this company has, first of all, it's got a lot of cash. So 6.8 billion in cash, significant increase on the previous year. Quite a lot of trade receivables, people who owe them money, and then inventory. And those are really the kind of the three main things, and that's what you'd expect to see in a business. You'll see that they've got some finished products. So this is kind of the materials, the raw materials, the work in progress, and the finished products, which are then going to be sold. They've got some property, plant and equipment, and mainly that is the equipment. So this will be all the kind of the machines that go ping, and all those kind of test tubes, and all those complicated machines that you often see on TV documentaries and Casualty, for example. Sum total $72 billion in assets, split between 52 billion in the non-current assets and 20 billion in the current assets. Non-current assets, so they've got these intangible assets. These will be things like the licenses we talked about. That's where the amortization comes in. And they've also got a whole lot of goodwill. And this goodwill arises on acquisition of other companies. So these guys, they're developing their own products. They are buying companies that have developed those products and plugging them into their distribution channel. And they are buying licenses from other companies to distribute or to develop those products as well. So multiple ways of making money, and it looks pretty successful to me from where I am sitting. So there's our balance sheet. That's the asset side of the balance sheet. Looking at the liabilities, we can see here's the current liabilities. So the current liabilities have risen a little bit, but there's no problem in terms of liquidity. So 20 billion of current assets, 12 billion of current liabilities, really no sleepless nights there at all. They've got a little bit of short-term borrowings here, but really the debt is sitting in the long-term borrowings. And again, the debt is, nothing to write home about. So no sleepless nights. They're quite comfortable with those levels of debt. They can service the debt, which means that they will be able to refinance it if they need to. And really, there's nothing else that kind of jumps out at us as they got quite a big other accrued liabilities. Not sure what those are, but there's nothing that really jumps out at us in the liabilities. The balance sheet looks pretty strong to me. In terms of the shareholders' investment, the equity element, the only thing that kind of really shows here. So we've got the this is the investment by the shareholders, and this line here is the retained profits in the business. So this is the total amount of profit they've made ever since they started trading, but not yet given back to shareholders. And as you mentioned, they are a big dividend payer, and that's reflected here, the fact that they're making a big profit in the profit and loss account, but we're not seeing these numbers increase, which means that those profits are being distributed as shares. Not only that, but we also notice here, there's a little bit of share buyback has been going on. Again, not much in the current year, but they are sitting on $10 billion worth of shares that they have bought back. Share buybacks, another way of returning money to the shareholders. increasing the capital value of the shares. So 33 billion in equity versus the kind of the nearly 20 billion in debt. So it's a little bit more equity than debt funded. It's a solid balance sheet. If only every company had a set of figures that looked like this, we would be out of business, Moe, very quickly. In terms of so this is the movement in the equity. Now we will have a little look at this, because what this is showing us, and we'll just go down to the earnings employed in the business. So this is this section here we're interested in. And what we see is from the previous year. So this is 2000. This is 2020. This is 2018. They start with 24 billion. They make a profit. They pay out a dividend. They finish with 24 billion. Okay. What they finish with at the end of 2018, they start with at the beginning of 2019. They make another profit. They pay out a dividend. They finish with 26 billion. End of 2019, beginning of 2020, they make a profit, they pay out a dividend, and they finish on 27 billion. So what we're seeing here is absolutely right, Moe. These guys, they are very strong, very regular dividend payers. And also what we might want to do is just to look at, let's compare the profit to the dividend. Okay, they're not overextending themselves. So they've got what's known as really good dividend cover. They're easily able to afford those dividends. And in fact, maybe if I was a betting person, those dividends look like they're going to increase even more. So they have been going up year on year. It looks like we're going to see the actual dividends increasing as well. Okay, so very good profit, very strong dividend payments. Lots of boxes to tick on this page. Let's go to the cash flow statement, which is, here we go. Here's the cash flow statement. So the cash flow statement, reconciling, the first part is reconciling the accounting profit with the cash profit. Here's the accounting profit, $4.5 billion, cash profit, $8 billion. So really, really strong cash flow higher than the accounting profit, mainly because of these two items here, the depreciation and the amortization, which are non-cash expense effectively. Okay, so these guys have really, really good, strong cash flow. Moving down a little bit in terms of the investing, a little bit of buying property, plant and equipment. That's really the big investing going on. They can easily afford it out of their cash flow. So if you have 8 billion coming in and you're spending 2 billion, again, not a problem. And then the rest they can use to actually to pay down the financing. So what's going on in the paying down the financing? So what's going on? These numbers here, this is refinancing of the debt, and we can see here. So as a general rule, they are borrowing less, so they are repaying more than they are borrowing. Okay, so if you borrow 4 billion and repay 12 billion, then you can see your debt goes down by 8 billion. If you borrow 1.8 billion and repay 3.4 billion, you can see your debt is going to go down by whatever the difference is between those numbers, etc., etc. So 1.6 billion. So less in this year. They borrowed 1.3 and they just under 1.3. They repaid just over 1.3. So the debt was reasonably consistent. But what you can see is that this company, they've made a strategic decision. They've been paying down that debt. 2018, it cost them money. They had to pay a redemption charge, but they are paying down that debt and then they're refinancing it. Now, not a problem for these guys to refinance it because they're very profitable. They can pay the interest. So the lenders are lining up to lend to these guys because they're absolutely solid as a rock. Not guaranteed, obviously, because nothing in life is guaranteed apart from death and taxes. And here we see there are the dividends. So there's nice, consistent dividends being paid, and really the financing cost is the dividends. Effectively, that's what we're seeing here. So sum total in cash terms, they're making $8 billion in cash. They're investing 2 billion. They're paying out a dividend of 3 billion, and the rest is being parked in the balance sheet. And we're seeing that just down the bottom of this cash flow statement. Let me just scroll down a little bit, and you can see that the cash has increased from 3.8 billion to 6.8 billion. It's gone up by $3 billion. So they've got an extra $3 billion. Now that extra $3 billion, they can park as cash, they can leave it there, rainy day account. They might use it to buy another company, to buy a license, to grow the business, or they might decide, actually, we can start to afford to pay even more dividends. So, you know, we're not sure what their strategy is, and you may want to be looking for that kind of an indication of that in terms of the kind of the latest set of you know, reports from the management. So all looking pretty good as far as we can see. You know, very, very healthy. Let's just look at the share price. So if we go back to the share price, here is the share price. And as you said, you know, they've gone from, you know, basically zero to, you know, if you bought in at the beginning, you'd have made you know, a very, very substantial return on your investment. But then, you know, the benefit of hindsight is always nice. Unfortunately, we don't have the benefit of hindsight. So now we have to think about what we've looked at and what does the future hold. So these guys, they are worth, the market capitalization is basically $221 billion. That is 35 times earnings. So 35 times earnings, that's expensive, but it's not massively expensive. So historically, it's expensive, but by today's terms, it's not excessively expensive. Basically, if they don't grow, it'll take you 35 years to get your money back. Dividend yield is 1.44%. So that is basically telling us that, you know, if you just look at the cash that you receive, it's getting 1.44%, which is better than you can get in a bank. Though, of course, if you put your money in the bank, you're going to get your money back. Whereas if you buy shares in this, the share price could go down. So, you know, it's 35 times earnings. There's a little yield in there. It's looking pretty good. 6 times sales. What I do think is interesting is, and this is a sort of, you know, slightly more advanced sort of analysis, is what we call the PEG ratio. Now, the PEG ratio is the price to earnings growth rate. And what we're looking at here is the growth in the earnings per share. So I mentioned that the earnings per share had grown by about 20% year on year. And so if you include that in the PE ratio calculation to come up with the PEG ratio, you get 2.31. Now, 2.31, just to put that in context, if it's below 1, it's generally an indication that a company is undervalued and it's a buy. And if it's above 1, it's an indication that it's overvalued and it's a sell. So I wouldn't say that this is necessarily a sell company, but 2.31 is high, and that means that this stock is expensive. So a lot of good news. A lot of good news is baked into the share price. I can't see these guys falling over. I can't see it kind of, you know, just tanking and going to the wall unless they make some really, really poor management decisions. So as part of a diversified income portfolio, I think that this looks, you know, not unreasonable to have exposure, but I'm not sure that I would be kind of betting on this. You know, I wouldn't be, you know, hoping for a 20 bagger from these guys. So this is at the boring end of your investment portfolio. It's a good solid company. It looks like you're going to get some capital gain going forward. It looks like you're going to get some dividend yield. It will bounce around. You can see it's been bouncing around, you know, like any other share. But, you know, and it's had a pretty meritoric rise from 2017. But you can see from 1997 to 2017, it didn't really go that far. It just bounced around a little bit. So I would be looking at, you know, quite possibly if I was looking at this share. So, you know, you can see it's kind of, it flatlined here and then it had a bit of a sort of a stellar run. And I'm kind of thinking, I can't see that. I can't see it carrying on like this. I struggle to kind of, you know, to put that. So I reckon that it's going to probably take a breather. It may even dip a little bit. And then it's going to kind of amble along, and it may do something like that, for example. Okay, and that's pure guesswork. But based on these numbers, I can't see the dotted line. I can't see that this is a kind of, you know, suddenly they've hit gold, and this is it, for example. Okay, and I may be wrong, and I'm happy to be proved wrong, and I'm happy for anybody who knows better than I do to put their comments in the stock. Say, Ted, you don't know what you're talking about. Be polite. obviously, but Ted, you don't know what you're talking about. This is why this company is going to turn into a, well, I say a multi-billion-dollar company, a multi-trillion-dollar company within the next 5 years. So there you go, Moeed. There's my analysis of Abbott, a nice, well-diversified, boring company. And it's only boring because it's profitable and it's generating cash and it's not about to fall over. And you and I have been looking at some really interesting companies which just seem to be wobbling like a jelly.
Yeah, totally. Definitely not boring in terms of what they're doing, for sure. In fact, they're one of the, I think they are the biggest producer of real-time blood glucose monitoring equipment, which is has been life-changing for people with diabetes. So definitely not boring, but certainly in terms of comparison to other companies we've looked at, as you said, really excited that we looked at this business because it's one that I've looked at for a while. Thank you again, Ted. Do leave a note in the comment section, as Ted mentioned, if you have any thoughts about this business, and particularly if you have any companies that you would like us to analyze for you. So do leave a note in the comment section. We will be happy to do that. As I said, probably about 95% of these videos or the companies we look at are based upon requests we get from our subscribers. So do leave a note in the comment section. So until the next video, thank you, everyone. Thank you, Ted. This was a really interesting video.
See you later, Moeed.